Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
Well, welcome everyone to our third series on retirement advice from some of the top retirement specialists in the country. In this segment, we're talking to investment advisor Brian Manier, MBA. Welcome to the show, Brian.
Thank you, Steve. Good to be here.
Brian, I love your title. You got this thing, The Power of Zero. Talk about that, because it sounds like you got a little inside track on that.
Absolutely. So when we do retirement planning, one of the questions that I always ask people is, do you think taxes are going to go up or do you think they're going to go down? What do you think most people say when we ask them that question?
Probably said it's going down, right?
Most people would say in the future they think they're going to go up. Their taxes, they're going to have to pay more taxes in the future, just with the way things are in our country.
So what do you think? You think it is going up yourself?
I think that they're going to have to go up at some point.
They're going to have to. And why is that?
Well, I think just because of the amount of debt that we have and issues with Social Security funding, and I just think we're going to have to be at a point where we're going to have to pay more taxes. Most people that I speak with would agree with that they would say, I think taxes are going to go up.
Okay, so if that's true, is your phrase, the power of zero, is our end game, at least, trying to get to paying the least amount of taxes we can?
Absolutely.
And how big is that in retirement? I think retirees don't get that.
They don't. I think two things that people miss a lot of times is how much taxes they're going to pay in inflation. What those two things, when you combine them, what that means to overall retirement.
Now, I notice you have a really cool idea. When you talk about Social Security, I think this is one of your Brianisms, right? I think it's called, Social Security is not a me decision, it's a we decision. Tell me about that.
Absolutely. So when people plan for retirement, a lot of times when I speak to baby boomers and they're either have filed for Social Security or they're getting ready to file for Social Security, they kind of look at the immediate needs and they don't really look at it as a decision with them and their spouse and the long-term effects of that, but they look at it as just what it means for them in the near term. A lot of people, unfortunately, they just need the income now, but they don't look at things like, what is my health? What does it mean for a spousal benefit? What does it mean for a deceased benefit?
So if you lock down at 62, that's going to be your spouse's number.
Absolutely.
So it really matters. Now, I know we all talk about this. I've done it on the show many times. I know you do as well. We really want all retirees to try to make it to age 70 before they draw down on their Social Security. But sometimes, Brian, we just can't. But you have some bridging strategies sometimes to get us there.
Absolutely. And what you need to do when you're looking at retirement planning is look at Social Security and retirement together. It's important. I think a lot of people will look at those individually and they don't bridge those two together. Most people would think, well, if I just take Social Security now and let my retirement continue to accrue, continue to marinate is the word I like to use, they think I'll be better off. And that's just not always the case. Sometimes by looking at their individual situation and saying, hey, maybe start taking your retirement assets a little bit earlier and then letting those Social Security benefits continue to accrue, may be better off for them. It may mean tens, maybe even hundreds of thousands of dollars depending on what they do. It's different for everybody. It doesn't always work that. Some people need the income now, but for others, it may be better to start taking those retirement benefits and let your Social Security continue to accrue.
Well, if we have a decent life expectancy, if you can wait till age 70, sounds like the way to go.
Well, when you consider at full retirement age, whether that's age 66 or 67, and you let that continue to earn 8% a year until age 70, that's pretty significant.
Yeah, I don't know if I can find anything that's dishing out 8% simple.
Very difficult. And then when you look at cost of living adjustments on top of that, that can be very significant.
Yeah, I hope they give it to them because, the last 6 years, three of the last 6 years, we haven't got anything.
Absolutely.
Let's talk about, a lot of people don't understand, hey, my qualified plan, my 401k, my IRA, this correlates to my Social Security benefits, whether they're going to get taxed or not.
Absolutely.
What's with that?
Absolutely. So when you look at how Social Security is taxed, it's a complex formula that most people aren't aware of, right? So you look at any accrued interest, you look at adjusted gross income, and then you look at half of your Social Security, and that's how they determine how much Social Security is going to be taxed. So what you take out for retirement benefits absolutely does impact how much taxes you could be paying on your Social Security benefits.
And if you want to say, Steve, I'd love to see that page, I'll send it to you. It's the provisional income test for Social Security taxation. Just write me at steve@rightonthemoneyshow.com. Let's talk about another tax issue. Now, life insurance, isn't it? I thought it was indemnification, protection,
Sure.
coverage. But you're saying, wow, there are cash value life insurance contracts now that we should look at for tax-free income.
Absolutely. So when you look at what type of strategies that you can implement to have income benefits where you're not paying taxes on the growth or distributions, a lot of people don't think of life insurance. They would think of Roth IRA, correct? Some people automatically go to municipal bonds, but most people don't think of cash value life insurance. And cash value life insurance is one of those few strategies that you can actually not only get tax benefits on the growth, but when you take the distributions out, as long as the policy is structured appropriately, you don't have to pay taxes on those distributions.
Okay, now this is because this may be new to some of our people now, and there are varying types of cash value. There could be this thing called, I've seen participating whole life, could be universal life, it could be indexed universal life, maybe even variable universal, I don't know. But there's a lot of choices here depending upon your risk tolerance.
Absolutely.
But this is just another one of your your arrow in your tax quiver here.
Absolutely. So when you look at, again, what you would be paying in taxes, let's say you had a taxable account. Most people are going to look at the growth on what that taxable account is going to provide each year. What they don't consider is the capital gains that they're going to have to pay each year. When you factor that in compare it to cash value life insurance policy, and you take away the market risk associated with that, in addition having liquidity, it can be a very nice strategy to implement into your overall retirement plan.
Now, I also noticed, because these are really tax-free policy loans, that again, this does not come on your provisional income test for Social Security. So this has nothing to do with your Social Security taxation.
That's correct. That's correct. It's not added into the formula.
I think that's another part of your power of zero, because that doesn't even interchange or correlate to it. Okay, let's talk about another thing. You talk about hybrid retirement. Hey, looks like we're going to have to, I'm working till 70. I'm not going to punch out at 66, so I'm looking at 70. A lot of my baby boomer brethren, we're thinking some part-time work, why we're in retirement. This hybrid retirement, kind of a new concept.
Absolutely. And when you think about when you look at Social Security and you look at what the benefits are between full retirement age and even looking at up until age 70, you can continue to work at full retirement age and make as much income as you want and not have any type of Social Security benefits withdrawn. If you do that before Social Security full retirement age, they are going to withhold some benefits.
I think this is the new cultural change. This is not our parents' retirement.
Absolutely.
Okay, let's talk about I love this idea, because we're all talking about the power of zero, all tax issues. The lower we bring our taxes, the more net spendable income I can take home. Roth IRAs, now I think they're just now becoming a little bit popular. They're just now becoming, I don't know if we did a bad job the last 10 years, but clients are like, wow, I think I do want to do the Roth IRA. Talk a little bit about that.
Absolutely. So again, it comes back to the question that I asked you earlier. Do you think taxes are going to go up or they're going to go down? If you think taxes are going to go up, pay the taxes now, get the growth, take the income out later without having to pay the taxes when you start taking those distributions.
Okay, now, if that was true, why would people not just do Roth IRAs instead of doing qualified plans?
Well, a lot of people do qualified plans maybe with their employer because they get a match.
Oh, that's a good part. Yeah.
Now, some employers they've implemented some Roth 401k. So I am seeing that with some younger clients now, where they have some opportunities to do that. You don't see it with everybody, but some people will elect to do a qualified plan because of the benefits that they get with their employer.
No, okay, I just want to kind of redux here. Power of zero, so Roth IRAs, no tax there.
Correct.
And the life insurance policy loans are no tax.
Correct.
Got to keep the policy in force for the life of the contract. But
absolutely.
Yeah. And then the other thing you're talking about, those two issues don't correlate back to your Social Security.
I was just going to say that. That's absolutely correct.
So that means that all three of those could be tax-free.
Absolutely.
So you're just putting more money. Now, how about people that, you're meeting a person in his 50s, he's got qualified plans. Can I convert some of this to?
Absolutely. You can do Roth IRA conversions, and that's something that we do try to help people with. It's not appropriate for everybody, but some people it's very appropriate to take their current IRAs. You want to make sure that you don't push them into that next tax bracket, obviously.
Right.
But it could be very appropriate as well. And by the way, once those are Roth IRAs, they're not forced to take those RMDs.
There's no RMD. I love
Absolutely.
that. Well, just keep in mind, this is a powerful tool. If I don't have to bracket bump myself up to the next level, I'm totally willing to do Roth conversions, pay the tax now so I can have other items later. Remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version right on themoneyshow.com and request information from this segment. In our next segment, we're going to talk to another top retirement specialist in our series on retirement advice. We'll be right back after the break.